Inflation is wreaking havoc on both the stock market but also the bond market. Fundamentally, why is this happening and what should you do about it? I got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. There's a lot that's weighing in on the markets right now, and you could point it back to the Fed and their aggressive monetary policy and the kind of maybe audacity to think that they wouldn't create inflation. You could say that it's their, them being behind the eight ball. You could say labor shortages, supply chain issues, all sorts of things, but it's very clear. I'm sure lots of those things are factoring in, but inflation is the big issue right now. And inflation, when we sort of run away like we're seeing right now, or far exceeding levels that would be, normal and comfortable for the economy, like we're seeing right now, it is creating significant challenges for investors and for the stock market and the bond market. Now, fundamentally, why is that happening, okay? I want to start with the bond market, okay? Because this one is, I would say, frustrating investors even more than the stock market decline. We're used to seeing stock market declines and no one likes it. This one obviously is longer and a little more painful than what we normally tolerate. But the bond market, this is acute pain. This is acute pain. When you go back and look at the bond market since the index started in the early 70s, this is the worst year on record for bonds by far, by a large margin. And so this particularly is frustrating for those of you that are on the cusp of retirement or in retirement. I saw some articles recently talking about how, I'm in retirement and I've got a 50-50 stock bond portfolio and I'm down a lot. I must be taking too much risk. Normally when the stock market drops during these sorts of declines, the bond market will usually hold its water. Either will go up a little bit or at least be stable, because while the market's dropping, the Federal Reserve is lowering interest rates, and that will help stabilize or improve bond investments. That's not the case right now. And so even lower risk investors, those of you close to retirement or in retirement, your bond portfolio is contributing significantly to declines in your portfolio. So why is this happening? For the smooth functioning of the overall economy, inflation and interest rates should be in parity. Okay? That's fundamentally how this is supposed to work. You should be able to take a very, very little risk buying a bond or a treasury bond, something like that, and they should be able to give you an interest rate that's competitive and in line with inflation. Otherwise, why would you invest your money with them? Why would you lend your money to them? That's what happens when you're a bond investor. You're lending your money to them in exchange for an interest rate. And that interest rate should at least keep up with inflation, so that you're not lending out $100,000 and by the time you get it back, it feels like it's worth less because inflation has eroded it away. Okay? So for smooth and normal functioning of the economy, inflation and interest rates should be in parity. Well, we had the government, in response to the pandemic, and when I say government, not trying to be political, Federal Reserve printed so much money, and sure, the White House, spent a lot of money and did stimulus and all that sort of stuff, but we printed a whole bunch of money. That started to create inflation, did tons of videos about that, talking about Cantillon effect and other things far before we were ever feeling it. But of course, that's what's happened, and the Federal Reserve said, we think it's temporary. We think it's transitory. There's not really inflation. And so as we started seeing and experiencing inflation, the Federal Reserve kept interest rates down here. And we had one of the largest gaps between actual inflation and actual interest rates ever. So real rates, one of the largest gaps ever. Well, inflation is still hot, 8.5%, 8.3 was the latest reading. And we are starting to increase interest rates to 3%, okay? That's still a significant gap. And from that viewpoint, you would say the Federal Reserve is still accommodating. They're still trying to, put gas on the fire here, okay? But interest rates, because inflation is so high and stubbornly high, interest rates needs to go up. They're not in parity with inflation. And guys, if you go back through history, this pain isn't over with until we get that parity in place. And then, of course, inflation needs to come back down to a regular level. And so that's why this could be more painful than and longer than any of us would want. But here's the thing, going back to bond investors. As interest rates then are going up, what's the relationship between interest rates and bond investments? It's a teeter-totter. As interest rates go up, bond investments drop. As interest rates go down, bond investments should rise, okay? So eventually that should happen. As inflation gets under control, interest rates can go back down, but guys, we're still marching higher with interest rates. Interest rates still need to go up. And with that outlook there, bond investments, as interest rates are going up, bond investments are going down. And that's very, very challenging and troublesome for those of you that are lower risk or in retirement and seeing that those bond investments, your safe, steady, sturdy investments have declined so much this year. That hopefully we're able to reach parity soon, okay? And then that relationship between interest rates and inflation will be at a more tolerable level for the economy, and then inflation can come back down, interest rates can come back down. But that's why your bond investments have had such a terrible time this past year. It's because of that relationship. Now in the stock market, it's a little more obvious why inflation is creating such a challenge and such a headwind. And really inflation impacts the stock. So the stock market is the cumulative valuation of companies traded on the stock exchange. Okay, so the stock value for an individual company is really just how much is that company worth divided by the number of shares outstanding. That's what the stock price is and what the stock represents. So the stock market is a collection of all of those. So it's basically valuations. Well, how do you value a business? It's essentially off of its profits. Okay. And so the first way that inflation impacts the stock market is inflation creates a lot of uncertainty about company profits. When expenses are increasing, that will reduce profit, right? And obviously inflation is a two-way street, so businesses need to increase the price for their goods and services. And will they be able to keep those in step? Will they be able to increase their prices for goods and services? And will consumers be willing to pay for that? Pay those higher prices while their input costs, while their expenses grow as well. And that would keep, that's what would be necessary to keep profits intact. Otherwise, profits get eroded, and that then the valuation, the value of businesses declines. That's all the uncertainty happening with inflation. But the other thing, and most people don't know about this, but once you arrive at a profit number, different financial traders and economists then have different formulas that they use based off of those profits projected out in the future to then value a company and determine what the stock fair value actually is. Well, as interest rates go up, part of the formula for some of those calculations, some of those, so stock valuations, some of the formulas are based on what's the interest rate that you can go out and get from the Federal Reserve. What's the interest rate you can go out there and get from Treasury? What's the risk-free interest rate? And therefore, the higher that return, that risk-free rate of return, the lower the valuation of the stock actually becomes, because you're taking more risk and you're not getting that much more return than you would get from a risk-free asset, a treasury type asset. And so therefore fundamentally and really geeky in the equation of how a stock is valued, rising interest rates actually can bring the valuation for companies down. Now, there's a lot of moving pieces, but that's at a kind of base level how that works. But regardless, inflation is creating a significant headwind in the bond market and of course in the stock market as well. I would expect that we're dealing with this pain until inflation gets under control. How do we get inflation under control? The Fed needs to raise interest rates until they're in parity. Inflation, it appears has peaked and should be coming down. Just might take a lot longer than any of us want and might require more Federal Reserve interest rates and withdrawal of liquidity from the economy, and therefore more pain ahead before things get better. Very possible. So what should you do? First, I would call for patience, focusing on that long-term perspective. Hopefully, the investments that you're holding right now, they're for your long-term financial goals. Otherwise, then you're using a long-term investment to accomplish something or achieve something in the short term, and you've got an imbalance there. So hopefully, for the majority of your portfolio, it's not needed. You're not going to need to touch those dollars for 10, 15, 20 years for the long term. And therefore, these ups and downs, while this one's acute and while this one has its own specific fact pattern, hopefully you're giving time for these dollars to go through these ups and downs and long term grow for your financial future and for your goals. So first thing I would tell you to do is have some resolve, have some patience, focus on that long term. Second thing that I would tell you to do is tune into your financial plan. Make sure you're taking the right level of risk for your overall financial plan. And for those of you at or near retirement, it's some of these dollars you might not. You know, some of the dollars will have a 5, 10, 15-year time horizon. Some of the dollars you might need next year or in the next couple of years. So that financial plan and working with your CFP should help inform you how much money should you hold in cash or short-term investments so that you won't need to sell when the market is declining or going down. You've got X amount of reserves that can feed or supplement your Social Security and so on. So working with your certified financial planner, tuning in your financial plan will help you make sure that you've stratified your investments that way. Even if you're on the cusp of retirement, there's dollars that you're not going to touch for 20 years. Those should stay invested for that long term. But the dollars you're going to need in the next 5 years or so, certainly the next 2 or 3 should be in cash. Over the next, a couple of years after that, those should be in lower risk investments as well, so that you're able to withstand potentially more investment pain before things get better. And then finally, I'd make sure that you've got the right investment strategy, the overall right investment strategy, and that you're using multiple strategies as well. Because the idea of just buy and hold diversification, buy high quality, low cost stocks and bonds, U.S. international. Right now, this is the worst year that we've had in a long time. I think the worst year ever for a 60-40 portfolio, a 60% stock, 40% bond. That's a typical 50-year-old, something like that, typical mix. Because of the way bonds have performed and how challenging it's been in the stock market, it's been the worst year so far. So should you add other components to that to add extra diversification, some other investment strategies, hedging, momentum strategy, some other adjustments, fixed investments, something like that? Should you balance that out so you've got more diversification? Work with your certified financial planner on that. On your overall financial plan to make sure you've got assets structured correctly and to ensure that you're taking the right level of risk. If you don't have a CFP on your team that can help you with that, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.